Hello again, traders, and welcome out. This is Ankit from Currencies, and I'm back with another educational piece here. And in this video, we'll be talking about volatility and taking a look at how to measure volatility in the currency market. I think the volatility is the key component that everybody should be thinking about when you're coming to do your analysis, looking at the chart, and then taking a look at what time frame should I pick for your strategy, because the way the things are moving in the markets, the volatility goes up and down, and we'll study in this chart as the volatility is constantly changing. And with this constantly changing volatility, we also need to make sure that we are using the right strategy that will tackle volatility. I mean, how many times you'll be in a trade and you get stopped out and you're right on the trade? I mean, a lot of times that has to do with volatility. You know, when things are moving really, really fast in a bigger range, sometimes things are not really moving as fast. They're directional, but the volatility is really low. So these are the situations that we come across on a day-to-day basis. So it's important to kind of know, okay, how do I do this in currency market? Because if you take a look at the equity markets, you know, we have the standard VIX. You know, we take a look at the VIX and we can kind of study that and say, well, this is the volatility in the markets. But when it comes to currency markets, there's not a centralized these ETFs that we can follow, or these indexes we can follow, where it gives us a good idea of what volatility is, because the volatility could change or could be different based on different currencies that you're trading. So let's just use an example here. We'll take a look at the Japanese yen. So one of the things, one of the most important tools that I use on a day-to-day basis to measure volatility is the ATR. So average true range. It kind of gives us a glimpse of what can we look at based on different matrix that you can put in. Most likely, I like to use the 14-day moving out the SMA on the ATR. So I'm looking at 2 full trading weeks just to give me an idea, okay, how things are moving. You can increase that time frame and decrease that time frame. So if you're using TradingView, you can go to indicators, type in ATR, get that added to your chart, and you can see that right here in the ATR, I can actually change the length of that. So this could change. Everything will look a lot faster, a lot slower based on the time frame I'm picking. We generally use 14-day, but you can bring it down to 17-day if you want to study this on a week-to-week basis. I mean, all of this is going to do is it's actually giving you more of this gyration, a lot of this back and forth, as you can see here. So the higher you go, the smoother it gets. So you can play around with it and see how this will affect or give you a better idea for the volatility. So we're back to 14 days. And we'll use the yen as an example here, and you can see the yen volatility right now is definitely at its highest. I mean, right now you can see the 2022 yen actually experienced some sort of volatility here, and you can see that we have seen volatility increase at certain times. So just right here, we see an increase in volatility, and then we have seen another spike in volatility back in September, and then you can see that the volatility kind of start to fade away. So notice that as the volatility is changing, if you're using a certain kind of strategy in this environment, not likely to work when the volatility is falling. So and then there are times when the volatility is just flat. There's not a whole lot happening. That's just giving you a glimpse of how quickly things are moving, so you can set expectations accordingly. So let's just go on dollar yen. We'll use dollar yen as an example just to measure that volatility. So you can see that as I take a look at this chart, and again, I can do that on a daily time frame. I can do that on a 4-hour time frame. So let's just use the 4-hour time frame, so that way it gives us a good middle ground on this analysis, not too long term and not too short term. So one of the things that we'll notice here is that there are times when markets are falling, or the currency price is falling, and the volatility is rising. So what is this telling me? This is telling me that I need to have a bit more of a wider stop, because the volatility is kind of high. On the other times, you can see where we actually seeing the opposite. You know, we are seeing the prices are dropping, just like from here all the way to, let's say, here. But then in between, you can see that the volatility was actually falling as well. What is that telling me? It's telling me that the prices are not moving as much, but it's definitely consistent. So this is telling me if I can be on a longer term time frame, I can sustain, or I can be in a better trade because I have a good direction with the low volatility. So my general rule is that if the volatility is increasing like this, I like to be in a shorter term time frame or have a wider stop. Because again, things are moving a lot faster, and if you just study this slope of that ATR, again, if you really go down to a 15-minute time frame or a 5-minute time, like this is where you will get the most kind of movement. But when you go in this falling environment, you'll notice that things are moving very slowly, but they're moving a little bit more consistently. And then again, you can have all these scenarios where volatility is falling, but the price action is sideways. But then you can have a pretty aggressive price action with a very aggressive volatility. And then based on that, you can decide, okay, which time frame to be picking on. When I see a lower volatility, this is where I like to be on a higher time frame because, again, you're getting a lot of noise in the short-term chart. But overall, within the range that we are seeing and consistency that we're seeing, you can do better on a higher time frame. And here we are. You can see that in this short-term time frame on a 4-hour chart, even though the dollar yen hasn't really gone anywhere, in this scheme of things here, we are pretty much unchanged for the price in the last few days. And we look at what's happening with volatility. Volatility is showing that things were moving a whole lot more because of this Bank of Japan rate statement we had this week, and there was a lot of volatility. As you can see, that we're still moving quite a bit. And again, if you go on a 15-minute chart, then you can see that, okay, where we saw an increase in volatility and where we saw a decrease in volatility. So right now you can see that the volatility is low and the prices are not going anywhere. So again, this is just telling me maybe it's just not really moving yet. But when you see in other times, where you're seeing a big move and with a sharp rise in volatility and a big fall, it's just telling you how quickly this move is taking place. Right now, we're in a low volatility environment without a direction. So you can kind of create these scenarios and how to deal or how to trade when there is a direction, then there's a higher volatility versus there's a direction, but there's no volatility. But then that means that I need to be trading on a higher time frame. As you can also get scenarios where there's a lot of volatility, but there's not a lot of direction. I mean, you can see in this case, there's no direction because things have gone sideways, but there's definitely a lot more volatility, which means that I can take advantage of the volatility, be in and out quickly, and be out of it. But what I see traders kind of do is, use the same strategy for every market condition. There are times where you can be in and out of a trade because, there's nice volatility, but not a whole lot of direction. But if you use the same strategy in an environment where there's a whole lot of, there's a nice direction in place, but not the volatility, in that case, I can't really use that strategy. I need to be in a trade where I'm getting a nice little entry point and just keep moving my stop. Again, I can be in and out. So in this situation, you can be in and out of a trade. You can have short-term trades where when things are not really moving that way, you can decide, well, if I have a low volatility and no direction, I don't want to be in a trade. That's where you're getting the lowest scores. At least I need to have a good direction with a little bit of pickup in volatility. Or things are moving, but volatility is actually relatively small because in that way, I'm less likely to get stopped out in short-term volatility and continue to ride on that trade. So realize all of that is done is conjunction with just looking at the chart and looking at the ATR. So what I would like everyone to do is just to make sure, you're kind of studying that. Studying what the volatility is like, always thinking what the volatility is. So then that way you can be prepared on which scenarios to pick, when to avoid trading, and when do you shift the gears. And because that's what it's all about, shifting gears. And as we look at the market environment, it keeps changing, so you have to adjust with the markets to make sure that you're profitable in all market conditions. And most importantly, when to stay out. Well, thanks for joining, and we'll see you in the next class.